If the stock market closed for 10 years, would you be happy owning what you own? That single question sits at the center of Warren Buffett's letters to Berkshire Hathaway shareholders. Those letters aren't about clever trades or quarterly theater. They're about how real owners think, decide, and behave when the scoreboard goes dark and only the business remains. They read the way good operating manuals read: clear priorities, simple arithmetic, deep patience, and a constant respect for what can go wrong. Here's the frame. We're not chasing hot tips, predictions, or shortcuts. We're extracting mental models that travel well across industries and cycles. The rules are simple, but not easy. Understand what you own, pay a sensible price, protect the downside, let compounding do the heavy lifting, and guard culture and reputation as if your livelihood depended on them, because it does. If you want a checklist to copy-paste, you'll get one. If you want a way to think that outlives today's headlines, you'll get that too. What to expect? We'll start with the owner's mindset and your circle of competence. We'll move to moats, intrinsic value, and returns on capital. We'll talk about cash as optionality, intelligent inactivity, opportunity cost, and what great capital allocation actually looks like. We'll define risk the way owners define it. Loss of capital, not wiggles on a chart. And we'll show how low fees, long horizons, and tax efficiency quietly dominate flashy tactics. Then we'll cover culture, incentives, reputation, and why per share progress is the scoreboard that matters. Finally, we'll close with a repeatable checklist and a meta lesson you can use tomorrow. 2 promises. First, no macro fortune telling. It's noise. Second, no jargon without translation. If a concept can't be explained plainly, it won't show up here. Pause whenever you hear something useful. Screenshot the lines you want to remember. This is about building a durable way to operate, not just a list of slogans. If that sounds like the kind of investing you want to practice for the rest of your life, let's begin. Lesson 1, think like an owner. Don't buy tickers, buy businesses. When you evaluate a stock, act as if you're buying the entire company. Because as a shareholder, you're buying a slice of everything: customers, products, cash flows, culture, and governance. Ask, if this business were private and I couldn't sell it for 10 years, would I still want to own it? That question filters out speculation, noise, and short-term trading urges. Lesson 2, define your circle of competence and respect its boundary. You don't need to know everything. You need to know what you know deeply and avoid everything else. The size of your circle matters less than your honesty about its edges. When you only play games you understand, mistakes fall dramatically. Lesson 3, demand a durable moat. A moat is a reason customers return and competitors struggle. Brand strength, structural low costs, network effects, switching costs, regulatory positioning, or unique culture. A business without a moat might shine for a season, but economics grind it down. Lesson 4, prefer a great business at a fair price to a fair business at a great price. Average businesses burn your time and attention. Great businesses compound without drama. Lesson 5, insist on a margin of safety. Intrinsic value is a range, not a point. Leave room for bad luck, bad timing, or bad forecasts. Your future self will thank you when the world throws a curveball. Lesson 6, focus on intrinsic value, the present value of the cash a business can produce over its lifetime. Book value is a crude proxy. Intrinsic value is the real target. Lesson 7, use look-through earnings. Don't stop at reported GAAP numbers. Add your proportional share of the profits from the businesses your company owns. This reveals the economic engine, not just the accounting snapshot. Lesson 8, prioritize sustained returns on invested capital. A company that can reinvest large amounts at high returns year after year is rare and priceless. Always ask, where can this business put the next dollar to earn more than its cost of capital? Lesson 9, cash is an option, not dead weight. Liquidity lets you act when others can't or won't. It's not about timing the market. It's about being able to take yes when the world says no. Lesson 10, intelligent inactivity beats hyperactivity. You don't get paid for the number of decisions. You get paid for the quality of a few big ones. Lesson 11, think in opportunity cost. Every dollar must earn more than your next best idea, or it should sit and wait its turn. Lesson 12, capital allocation is the CEO's superpower. Reinvest in the business. Acquire when it's clearly better than internal opportunities. Repurchase shares below intrinsic value, or hold cash when nothing qualifies. Indiscriminate growth is not a strategy. Lesson 13, buybacks create value only below intrinsic value. Repurchasing above worth transfers value from remaining owners to exiting sellers. Lesson 14, don't issue stock when it's undervalued. Cheap stock is precious. Using it as currency dilutes your partners. Lesson 15, avoid dangerous leverage. The best businesses can endure recessions, surprises, and mistakes. Debt turns survivable errors into fatal ones. Lesson 16, risk isn't volatility. Risk is permanent loss of capital. Prices will wiggle. Your job is to avoid ruin. Lesson 17, keep costs tiny. High fees and high turnover compound against you. For most investors, a low-cost index fund is the optimal default. Lesson 18, let taxes work for you by minimizing turnover. The longer you hold, the longer your capital compounds before the taxman takes his cut. Boring is profitable. Lesson 19, ignore macro predictions. Forecasts change nothing about the value of a great business bought at a sensible price. You can't predict, but you can prepare. Lesson 20, float is powerful if underwriting is profitable and risks are prudent. Cheap capital is only cheap when it's stable and well managed. Lesson 21, don't reach for yield. Extra basis points often hide extra tail risk. If you don't understand the downside, you don't own the upside. Lesson 22, judge by per share progress, not empire size. Assets and revenues can grow while per share value stagnates. Owners eat per share outcomes. Lesson 23, culture and integrity are non-negotiable. Incentives must align with owners. Gray areas are red flags. Lesson 24, reputation takes decades to build and minutes to ruin. Walk away from anything that risks the franchise. Lesson 25, prefer managers with skin in the game. They talk and act like partners, not promoters. Lesson 26, use a checklist. Moat, management, reinvestment runway, balance sheet strength, valuation, and Pacific risks. Checklists don't make you smart. They keep you from being dumb. Lesson 27, match duration. Don't fund long-duration assets with short-term liabilities. Liquidity mismatches sink otherwise good enterprises. Lesson 28, beware acquisition fever. Deals done for headlines usually bleed owners. Demanding discipline on price and fit protects you from regret. Lesson 29, goodwill is fine if and only if it earns sustained excess returns. Final lesson, play the long game with people you trust. Owner mindset, circle of competence, durable moats, fair price, safety margin, disciplined capital allocation, low costs, long horizons, and an unbreakable culture. That's Buffett's playbook. If this helped, like and subscribe, and tell me which lesson you'll apply first, because time is the friend of the wonderful business.